Okie dokie. It looks like we figured this out. Thank you for your patience, everybody. This is our first meetup where we've got new individuals in charge of different parts of our scheduling the event. I'm Kaylee McMahon. Apartment Queen Investments is the name of my business. And we just happen to have 2 Zoom invites. So I guess I picked the right one. So everybody, welcome to the meeting. Jake Jackson, again, thank you for your patience. I'm going to let you get started after the coordinators of this event, Harita being the first one introducing herself. And then after that, we'll go ahead from there and get into Jake's section. Go ahead, Harita. You're on mute, my lady.
Welcome, guys. Welcome to our first meeting today. And I am so happy to have you all here. This is our first meeting, and I'm so excited to meet you all. And let's learn about new investing opportunities. I am always open for new opportunities and looking for put my money. Today we have with us Jake Jackson, and he will be introducing us to the oil and gas investments. So our agenda is like this. First 30 minutes, we have our topic, oil and gas investments, and 10 minutes, Kaylee will give us an update about multifamily. And then we have 30 minutes of questions and answers. There are few housekeeping items. We can put our questions in the comment box and try to be as interactive as possible. Since we have a new team this year, let's introduce to the people. Chelsea, do you want to go first? Is Chelsea there?
Yes. Hi.
Hey. Yeah.
Hey, yeah, I'll make it short and sweet. I'm Chelsea Hobbs. I'm originally from Texas. I still live in Texas. I'm an insurance broker. I work with Kaylee on some of her multifamily properties. So yeah, I also work with contractors, oil and gas, all that on the PNC, property casualty side of insurance. So just happy to learn more and happy to sponsor this event. So
thank you,
Thanks,
Chelsea, for being
Chelsea.
here.
Raquel Atkins, do you want to introduce yourself?
Hello, everyone. My name is Raquel Atkins. I am Investor Relations for the Apartment Queen Investments. I'm so happy to be here and learn about oil and gas. My knowledge is all about multifamily, and I have no knowledge about oil and gas, but I'm very interested.
Thanks, Raquel. I am Harita Kunjeti. I am based in Dallas, and I am a software engineer and looking to transition to multifamily. I am in residential space, but I am educating myself and looking to transition to multifamily. And I'm here to help Kaylee with running these meetings, and I am the host of this meeting. And Kaylee, do you want to tell a few things?
Yeah, sure. I'm Kaylee. I am a multifamily geek just because I've been through the good, bad, and the ugly when it comes to partnerships, single family going into multifamily, that transition of moving your cash. It's not a zero down game for sure. When it comes to partnerships, when it comes to construction, when it comes to asset management, and now soon to be property management, because I'm actually moving into one of my properties and I'm going to take over the property management too. So if you need to know anything about multifamily, that's something I've done for 5 years and continue to look to do that for the next at least 10 years, if not longer. And looking to help women that want to get in this space, because if you were me when you got started, I was totally intimidated by the amount of guys that are there. And the fact that I couldn't go, bird hunting, bird hunting with them. to hang out with them. Creating a different dynamic is what we're focused on here. So Jake, are you able to speak or can you hear us?
Yes, can you hear me?
Yes, 100%.
Okay, my office manager is not here, so I'm very technically challenged. I'm just trying to figure out how to get my face on the screen. I see my name, but I don't, can you see me? No?
Not yet, but there is a video on the bottom left corner that you have to
Okay.
click.
There we go.
Yes, we see you.
Okay, here I
yes.
am. All right, how are y'all doing?
Okay.
Thank you for allowing me to come and speak with you guys today. I do appreciate it.
Sure.
Yeah, 100%.
Yeah. So I have some clients that do a lot of multifamily. I actually own multifamily real estate as well. So it's funny because I'm not really trying to learn more about it, but my wife is trying to get a lot more involved with it, do some cash out refis, do the same thing we've already done where we picked a unit, we fixed it up, got it rented out. So we're ready to do it again. But that's kind of interesting how, you guys are doing that. We're doing oil. You want to learn about oil, and we're kind of doing multifamily. So
100%. Jake, I've just noticed that we've had some investments of ours, or as far as our acquisition strategy, everything that we look at kind of reminds me looking back at like 07, 08, where there's not enough spread there to make a good return. So we really haven't acquired anything in like 14 months and totally switched our strategy. So that may change here soon. But in the meantime, a lot of our investors, 21,000 in our network, have asked, what else, And so specifically, I know that this investment is similar or related to, not related to, but similar-ish to multifamily. And actually another multifamily investor actually mentioned investing with you, and that's how we hooked up. And so, if there's some synergy and it makes sense, I don't mind making the introduction. And also for us, understanding what are the similarities and the differences, really.
sure. Yeah. So do you want me to just go over like the real risks of what it is that we're doing? I'm sure that's probably what you want to know, right? So on all the stuff that we do, we're not an operator. We don't drill. What we're trying to do is we're trying to partner with companies that are the industry majors. If you're going to start a shoe company, I would think Nike, Reebok, Adidas, big players that have made billions of dollars doing it. They're the experts. They know what to do. We're trying to partner with companies like that. And so companies like that are Devon, ExxonMobil, ConocoPhillips, Chesapeake Energy, Comstock Resources, who's owned by Jerry Jones of the Dallas Cowboys football team. Got a bunch of wells with Jerry. But we're trying to tie ourselves to big operating companies because they're the ones that are going to spend a lot more money than us. They have, everybody that's in their field is an expert. The reservoir engineers, they're, guys from top to bottom are probably the best in their field. That's why they're with those companies. So it's a lot less research and things that we have to do when we tie ourselves to companies like that, because they've already done it. They've already done the research. They've already went out there and drilled the wells, and they have a very, very good understanding about what they're trying to do. And obviously when, they generate millions of dollars of income doing it. So they're obviously good at what they do. So we would rather, partner with ExxonMobil than try to compete with ExxonMobil. So that's basically our business model, is to acquire oil and gas leases that are inside of drilling units where these companies drill. So that allows us to participate with them in the drilling for our proportional share of ownership of equity. And so that's basically the whole name of the game for us, is identifying properties, locations where there's already millions of dollars worth of revenue that's been generated. And then these companies are coming back to these drilling units to develop the rest of the drilling unit. Meaning, if a drilling unit is 640 acres, that's enough room to drill 10 wells. So what they'll do in the very beginning is they'll come in and they'll drill one well inside of a drilling unit to test the location, to test the area, to see how productive it is, how big, how much oil and gas and how much money they can generate. And then what they do, they'll put down a bunch of well bores inside these drilling units to hold the drilling unit. It's called HBP, which is held by production. And so they'll drill one well and lock up all of these drilling units. And then they'll come back to the drilling units years later. They'll come back to the ones that are the most profitable. And then they'll do developmental drilling where they're not exploring since they've already found it. They're developing the rest of the drilling unit. And that's what we are interested in buying. Are leases that are already proven in areas where there's already millions of dollars worth of revenue that's been generated. And these companies are coming back to develop the rest of the unit and get however many wells they can inside those drilling units. Those are the units that we're interested in buying, the leases that we're interested in participating in. Yeah,
Should we just place our
So,
questions in the question box for later?
sure.
Okay.
Or you can ask, I mean, however you want to do it. I'm looking for a box.
What's the hold time typically?
Hold time meaning like how long does it take to do all of it?
How long am I gonna keep my money?
Oh, how long am I gonna keep your money? So the money that we raise, it goes to pay for all the drilling and whatnot. The one that we're currently doing, it's already sold out, but the drilling will start in June or July. So we raise that money and that money is ready to go when these operators come and drill the wells. We send it right to them. So, you know, we're not kicked out of any participation. But as soon as the wells start drilling and they start producing, we're going to send the money back in the form of monthly revenue that comes on the 20th of every month. And that's the part that we don't know. Like, we don't know how big the wells are going to be. We don't know how much oil and gas they're going to generate. We don't know how long they're going to last. We don't know what the commodity prices are going to be. So that is the risk for us is if it's a good well, like investor that you know that is doing multifamily, he's participated in some of our projects that sent back 100%, more than 100% of his money in the first 6 months.
Yeah.
So he sends me 100 grand and 100 grand's back in 6 months time. And most of these wells are horizontal. So they go straight down, they find the oil and gas, and then they drill through it for up to 2 miles. And based on that distance, the operators, I have a little quick video too, but the
Yeah.
operators predict that they could last for 20 to 40 years. So if I can get somebody's money
Yeah.
back in 2 to 3 years, which is always the goal, it's a 2 to 3 year payback is where we try to stay. Because obviously if it overperforms, nobody's going to be upset.
Right.
Get their money back before that. But 2 to 3 years off of a well that could cash flow for 20 or 30. That's the whole goal. And then there's substantial tax benefits too.
Oh yeah, let's go over those.
Yeah, so when these guys, so what we do is we put everything into a limited partnership. Okay, and you can invest as a general partner, which allows you to get tax benefits for active income, or you can invest as a limited partner, which allows you tax benefits for any type of passive income. So any kind of income that you're not actively working to generate would be passive. You could sign up as a limited partner. And can I share my screen?
Yes.
Can I share the screen? Okay. Okay, it says host disabled participant screen sharing.
Oh, that's me, huh? I'm coming.
Okay, no worries.
Mm.
Because I have a K1 that I can show you. That way you'll see, if someone invested, they can see
Seriously.
exactly what they're going to get.
That's real.
Kaylee, I think you have to make him a host.
Actually, we're gonna make you a co-host.
Okay,
Ready?
I'm ready. Okay, we're good to go?
Yes.
Okay, can you see my screen?
Nope. That's amazing. Yeah, there we go.
Okay.
What?
Let me, okay, there we go. Okay, so on this K1,
Wow.
this was for the Permian #2. It's a partnership we did out in the Permian Basin. And you can see that the investor invested $100,000 on this partnership. So it's the capital that was contributed during the year. And then the loss, which is right below it, was $86,364. So they put in 100 grand. Next year, the following year in March, we send them back this K1 that shows of that 100,000, 86,000 was considered a loss. The 13,000 that's left over, that will get written off over the next 5 years. Okay, so what my clients do is every year, and we have 200 clients. We have more than 200 clients here at our firm, and most of them are business owners. Most of these clients are tax planning throughout the year. So I have one guy in particular that stands out. At least every quarter, he needs $200,000 to $300,000 worth of write-off.
Wow.
So if we do 7 to 8 projects, partnerships a year, I've only got so many that he can invest in to hit his tax planning goals. But this is a big reason why they invest. They get huge losses, but the money isn't lost, because as soon as the wells come online and they start producing, this money goes right back to them. And then 15 cents of every dollar is tax-free, because you're pulling out a natural resource, which is called depletion. It's a depletion allowance. But this is a huge reason why our business is successful, is because we look for people that need tax help. They're in huge tax brackets. They need federal income tax relief. And obviously, when you participate in drilling, the government, believe it or not, they incentivize domestic drilling, domestic production, so we don't have to rely upon foreign oil. So they, in the tax codes, they give these big tax write-offs, which are basically IDCs.
What's
So,
that?
intangible drilling costs.
Mm.
Those are the big write-offs that you get. So a lot of the intangibles, things that you can't get back, whatever you put in the ground, you can't get out. Fracking, drilling fluid, sand, things like that. But it accounts for a big chunk of the write-off. So they do an investment this year, they do another investment next year, they're getting huge chunks taken off, showing it as losses, and it shelters their income and it lowers their tax brackets. In a nutshell.
Which is what we all want. Can you explain depletion allowance one more time?
Yeah, it's 15 cents of every dollar is tax-free, because you're depleting a natural resource. So it's 15 cents of every dollar would be tax-free. And I'm really not supposed to give any tax advice, because I'm not a CPA or anything, but I understand how the K-1s work. But that's what you do get when you invest. It's 15 cents of every dollar is tax-free. And these K-1s, they go out every year in March, middle of March. So revenues being generated, these K-1s, it tracks everything. And we have a CPA. Our CPA is Mike Pine, who owns Pine and Company. They're actually right up the road from us. So they do all of our tax documents, K-1s. And they're usually in hand by the middle of March. And then we'll email them out. That way people aren't waiting on them in the mail, or they get lost. So as soon as we get them, they go right out. And then this is what it means: 4 or 5 pages. There's the intangible drilling cost, IDCs, 61,000. But anyway, we'll send out K-1s, and they're really nice. It's the big reason why a lot of people do it is because they get huge tax losses. Now I do have a video that I'd like to show you, if that's all right.
Yeah, I'd love to see it.
Okay. Okay, so this is a little quick video about
geologists have known for years
about horizontal drilling, because a lot of people they can't really wrap their heads around horizontal versus vertical. Back in the day, like in the 70s and 80s, a lot of wells that were drilled were vertical. They would drill them straight down and then frack out. Okay. They don't do that anymore. At least these companies that we're working with, they don't drill a vertical well. And this little video right here will show you. And it's like 5 minutes. But I'll just show you real quick what they do, because it's exactly what we're doing.
With modern horizontal drilling techniques and hydraulic fracturing, the trapped oil and
Can y'all hear that?
gas in these shale reservoirs is being safely and efficiently produced, gathered, and distributed to customers. Let's look at pipes called casing, cemented in place, provide a multi-layered barrier to protect freshwater aquifers. During the past 60 years, the oil and gas industry has conducted fracture stimulations in over 1 million wells worldwide. The initial steps are the same as for any conventional well. A hole is drilled straight down.
I'm not seeing the video.
Fluids, which cools the drill bit, carries the rock cuttings back to the surface, and stabilizes the wall of the wellbore. Once the
That's
hole
true.
is
If we're supposed to be
completed,
seeing a video, we can just see your background, not the browser window.
called surface casing.
Can you see the
Next,
video?
cement is pumped
No,
down
just
into
your
the well.
background.
Yeah, it just says the United Exploration.
Right now.
The borehole wall.
Yes.
Okay, yeah,
Okay.
here.
Additional protective
I told you, I'm
barriers
technically
between the wellbore
challenged here.
And any freshwater sources. In some cases, depending on the geology of the area and the depth of the well, additional casing sections may be run and, like surface casing, are then cemented in place to ensure no movement of fluids or gas between those layers and the groundwater sources. What makes drilling for hydrocarbons in a shale formation unique is the necessity to drill horizontally. Vertical drilling continues to a depth called the kickoff point. This is where the wellbore begins curving to become horizontal. One of the advantages of horizontal drilling is that it's possible.
So
to
they
drill
can
several-
actually curve the bit. Okay, it's hard for people to get their head around that, but they'll go down 10,000 feet to where the oil and the gas is trapped, and they will literally curve the bit. The technology that they have, it's incredible. We could talk an hour about technology that they have. I mean, they literally have GPSs in these drilling bits that are linked with satellites in the sky that tell them exactly if they move 1 inch to the left or right. But they actually curve the bit 10,000 feet down so they can go horizontal.
Walls from only one drilling path, minimizing the impact to the surface environment. When the targeted distance is reached, the drill pipe is removed and additional steel casing is inserted through the full length of the wellbore. Once again, the casing is cemented in place. For some horizontal developments, new technology in the form of sliding sleeves and mechanical isolation devices replace cement in the creation of isolations along the wellbore. Once the drilling is finished and the final casing has been installed, the drilling rig is removed and preparations are made for the next steps, well completion.
So this is
First step in
fracking.
Completing a well is the creation of a connection between the final casing and the reservoir rock. This consists of lowering a specialized tool called a perforating gun, which is equipped with shaped explosive charges, down to the rock layer containing oil or natural gas. This perforating gun is then fired, which creates holes through the casing, cement, and into the target rock. These perforating holes connect the reservoir and the wellbore. Since these perforations are only a few inches long and are performed more than a mile underground, the entire process is imperceptible on the surface. The perforation gun is then removed in preparation for the next step, hydraulic fracturing. The process consists of pumping a mixture of mostly water and sand, plus a few chemicals, under controlled conditions into deep underground reservoir formations. The chemicals are generally for lubrication, to keep bacteria from forming, and help carry the sand. These chemicals typically range in concentrations from 0.1 to 0.5% by volume and help to improve the performance of the stimulation. This stimulation fluid is sent to trucks that pump the fluid into the wellbore and out through the perforations that were noted earlier. This process creates fractures in the oil and gas reservoir rock. The sand in the frac fluid remains in these fractures in the rock and keeps them open when the pump pressure is relieved. This allows the previously trapped oil or natural gas to flow to the wellbore more easily. This initial stimulation segment is then isolated with a specially designed plug, and the perforating guns are used to perforate the next stage. This stage is then hydraulically fractured in the same manner. This process is repeated along the entire horizontal section of the well, which can extend several miles. Once
Okay, so they'll go in there and they'll drill them 10,000 feet, which is 2 miles. We've seen them do them 15,000 feet, which is 3 miles. And they will drill for 3 miles and they will frack the entire leg. And I'll just let you tell them. I'll let you, this is what they say that they can get.
3 months of completion activities, which includes 1 to 7 days of stimulation. But this 3 to 5 month investment can result in a well that will produce oil or natural gas for 20 to 40.
So based on the distance, based on going 2 miles to 3 miles, horizontally and doing fracturing the rock that holds the oil and the gas. That's why they predict they can get 20 to 40 years out of the wells. So every single one of these partnerships that we do, the well is either a 5,000, 10,000, or 15,000 foot horizontal. And based on that type of drilling, we've never missed a well. So the risk isn't that they're going to drill the well and it's going to be dry and you're going to lose 100% of your money. The real risk is going to be, we don't know how big the well is going to be. We don't know how long it'll last. And we don't know where the commodity prices are going to be. But we have done more than 100 wells doing this horizontal drilling, and we've never seen a well come up dry. So they all send back, money based on, this type of drilling that they do. But I wanted to show that because it's, it's not like Mama and Papa drilled them back in the 60s and 70s. It's completely different. Do you guys want to see what the reporting looks like? Yeah.
I would.
Okay.
Jake, while you're
Okay.
loading that up, I just had a quick question.
Yeah.
You were saying that the biggest risk is in terms of how long the well will last. If the
That's one of
companies
them.
if the companies is doing the survey and the assessment, wouldn't they be able to tell how big the well is? That's the part I'm not understanding.
They have an idea based on surrounding production, meaning other wells in the same immediate area, but they never know how big or how long they're gonna last or produce until they frack them and turn them on.
And what's the shortest you've seen in terms of your investments?
Well, we started in 2015. The first couple of years we did vertical drilling, which is the opposite of horizontal. We started doing this business model in 2018, and we haven't had, they're all producing. So I don't have any that are not producing.
Thank you.
Yeah. The reporting, so what the reporting looks like. So if you're a client, this is our stack number 12. Can everybody see this on the screen? Okay.
Yes.
So this was our stack number 12 partnership. It was 4 wells. These are the wells over here, the Columbine. There's the 4H, the 5H, the 3H, the 2H. But what we do every month is we do the breakdown for the clients. So the reporting will look like this. It'll come from Devin or whoever the operator is, and it'll show you how, what was produced, which over here is all plant products. That's like natural gas liquids, methane, butane, propane, stuff like that. This is the oil right here. And it shows you that it sold for $85.93. It was 16,000 barrels, and that generated this revenue right here. But every month we'll get reporting from the operators that show all of this information for each individual well. And then we do the accounting to break down to show you how much revenue was generated for the partnership gross, which is this number. The lease operating expenses, those are expenses that come out to keep the well running every month. They're usually very, very, very low. But out of that, almost $18,000, $1,300 of it was expense to keep the well producing. We have a $200 management fee. And then the partnership net revenue was $16,406.34. So that's how much the distribution was. And then if you owned a unit in this project, we show you how much your share would have been. So if somebody owned a unit in the project, then it would have been $8,000 per unit. But this is the breakdown of it. I can also show you the I can also show you what reports look like.
Yeah, I'm curious what they look like compared to multifamily, and then curious not only reporting because, well, I want to see what you report on because I want to understand how we value this type of asset.
Yeah, let me see how to give the revenue. Already showed you the K1. when we do the revenue is always direct deposit, so it's an ACH form. I'm
Mhm.
sure everybody knows what that is.
Oh, yes.
Oh, that's like. There we go. Okay, share screen here and share this. Okay. This is a well that this is a well that just got fracked. So it comes directly from the operator, which at the top you can see it's Comstock Resources. That's Jerry Jones from the Cowboys, his operating company. But when we get reports, we send these reports out to the clients. So this is what a report would look like from the operator. And those reports basically go out to keep you updated with the progress. So you know if the well is drilling, if the well is fracking, what stage the well is in. So we'll send out these, as soon as something happens to the well, if it gets drilled, it gets fracked, we'll get these reports from the operator, and then these reports will go out to the clients. But looks like that. Bunch of oil and gas mumbo jumbo. And then we'll usually call the clients if they have questions and whatnot, and go over the reports and show them, hey, this is what's happening and whatnot.
I think that if it's not just me, I'm just seeing your inbox for Outlook
Are you?
on the screen. Yeah.
Okay.
Want to share again, and then maybe select the screen we want to see.
What about that?
Yeah. Perfect.
Okay, I'm so sorry.
No problem.
It's a lot easier when my office assistant is here, I'll tell you that.
Well, we're learning. It's okay.
But yeah, so this is what, and I'm sorry, but this is what the report looks like.
Okay.
At the top, it'll show you the operator, who it's coming from, the well name, and then it gives all the information about the well, what's going on with the well. And then we'll send those out to keep everybody updated on progress.
And
And what are the, I was going to ask, what's the normal buy-in, minimum buy-in normally for one of these types of
Normally,
projects?
it's anywhere from 20 to 25,000. And that would get you a piece of all the wells that we're funding. So if there's 10 wells in a partnership or 3 wells or whatever it is, one investment would get you a piece of all of it. On the one that we were just funding, it was $100,000 unit, and 25,000 was the minimum investment, which was a quarter of a unit. I don't really have anything else to show you. I showed you the K1, the reporting, what the reports look like from the operator, our accounting that we do, and we send those out. I can't really think of anything else that we would have to show you that you haven't already seen.
Jake, we've got
For
a couple
that-
of questions. Go
Yeah.
ahead.
Yeah.
My one question is, from that one example you showed earlier where the one unit was about $8,000
Yeah.
of monthly profit, what was the buy-in amount for that one unit?
It was probably around 100. Most of
100,000.
them are anywhere from 100 to 120. If it's a really large raise, it might be 150. But we break. So if it's $1 million raise, we know that no client is going to do $1 million with us. So what we do is we take $1 million raise. We'll take 10 units at $100,000 a unit to break that number down. And then normally we just, the larger the raises, the higher we'll pick for the unit price. But it really just depends on how much we're raising. It's just a number we pick so we can break the number down. Is there any other questions?
Yes. We answered a couple of them already.
Okay.
Do projected returns change, or is it typically in a certain range?
Typically, our business model doesn't change. The only thing that changes is the location and the operators. They're all publicly traded companies. They're all 5,000 to 15,000 foot horizontals. And we don't change much other than the location and the operator. Most of our wells are on track to pay out in 2 to 3 years or less. Now, it always fluctuates because the price of oil and price of gas fluctuates on a daily. And the way we get our revenue is what they'll do is they'll take a 30-day average. So whatever the 30-day average was for oil or gas, when they go to sell it, we'll get the average of what the price was for that month. And then that's how, and then obviously when we send out the reports, you'll see how much oil was sold, how much gas was sold, what the price was. So it's all line item. But that does fluctuate, and we'll get an average for the 30-day, you know, whatever the price was for the 30 days in the month. And then when we get revenue is always 3 months behind.
Mhm.
So if we're in February, this next distribution that we'll be doing will be for November's production. So whatever was produced in November and generated income, we'll send that income out this month for February, because we're always 3 months behind. And that's typical anywhere you go. It's always like that. Before I started this company, I worked for 2 other companies. They're always at least 2 to 3 months behind for revenue. I believe they do it for reporting, so they can do all the reporting that they need to report. And then when the wells start producing, there's about a 3 to 4 month lag time. So once they come online and they start producing, 3 to 4 months after they start producing is typically when we get the check from the operator. And then across the board, from everything that we've done from start to finish, I believe this project that we just finished was our 41st project. So our next one will be our 42nd partnership. We're more than 53% paid out across the board, and that's cash on cash with 0 tax benefits included. So if you bought everything that we did from, you know, inception, you're more than 53% paid out if you don't use any tax benefits whatsoever. So that's our track record.
Wow.
And that track record is in the books that we send out, the offering documents that we send out. There's a prior activities page, and it shows every single partnership we've done, how much money we raised, and how much money we've returned. And it's all cash on cash. It's not, there's no tax benefits included. If you include the tax benefits, which a lot of companies like to do because the returns aren't as high, which is a big reason why I started this company, it'll boost you another 30, at least probably boost you another 30%. So if you're at 53, just tack on another 30, you know, you'd be at 83% across the board.
Wow.
Because the tax benefits, you know, they're pretty substantial.
No joke.
Yeah.
So I
But
think I heard earlier about, we have a question about the term of the investment. I
Sure.
heard earlier about the investment being variable, basically, because of the fact that you could stay in an investment, it could continue to cash flow really well for a long time.
Sure.
Is that basically like a evergreen situation where it continues to roll, or you can pull out at any time? How does that work?
The money is not liquid. So once it goes in, it's in there. You can't pull it out because there's no way for us to pull out drilling pipe and sand and everything that they put into it. There's no way to pull it out and get money back.
Okay.
So the goal is truly it's a long-term investment, you know. And like I said, the goal for us is try to get all the capital back in 2 to 3 years. I've done it as fast as 6 months, but 2 to 3 years is kind of the time frame that we're trying to, you know, off of a well that could go for 20, 30 years. That's kind of the time frame. We had six in the last 6 months, we've had 6 different partnerships pay out and send 100, you know, more than 100% of the capital back. And so every month, those people are just in the black. They're profiting every month, and the partnerships are designed to last for 30 years. If the well is still producing and it's still generating a lot of money in 30 years, United's not going to shut the partnership down because it says, you know, they're supposed to last for 30 years.
Mhm.
So if it's still generating income and I'm putting money in my pocket like everybody else is, you know, it's going to keep going. Partnership's going to stay open.
What would be some of the main risks, Jake?
The main risk is going to be that we don't know what the well is going to do, and we don't know what commodity prices are going to do.
Mhm.
3 months ago, natural gas was at $10 per MCF. Today it's at $2.50. So when the war hit, Russia, Ukraine, you know, the EIA said that 45% of the European Union's 2021 gas imports, they came from Russia. So when Russia, you know, was with Ukraine, they're trying to you know, not supply them gas. Gas prices went through the roof. You know, the highest I've ever seen them, almost $10 per MCF. So we had returns like 12, 13% or more a month. You know, we're used to, you know, maybe 3 or 4. So
Wow.
that is, that's one of the things that we're tied to is, you know, the prices can go through the roof and so can your revenue.
What would be the worst case scenario if the war in Ukraine does not stop?
Well, what dictates prices for the most part, not sometimes market fear can prices can go up and down, but for the most part, it's supply and demand. And I do know that for a fact, we're at the lowest levels for oil that we've been since 1983. We use about 18 to 20 million barrels a day in consumption. And I believe the last reports, there was 371 million barrels in the Strategic Petroleum Reserve, meaning there's about 18 days left before we're on zero. So gas prices have fluctuated, but oil prices have been pretty steady for, you know, last year plus, sitting around $80 a barrel. And $80 a barrel, we can do really good. You know, in our last project, we had a well that was very close to where we were drilling. It had produced about 300,000 barrels of oil, and $80 a barrel at 300,000 barrels is $24 million worth of revenue. We're drilling right next to it on the partnership we just finished funding.
Holy Hannah.
But that's what we look at. If it's really good oil prices and it looks stable, then we're going to chase oil, you know, for our next projects. And if gas looks like it's, you know, going through the roof like it did last year, we'll do like we did last year, and we'll stay on natural gas. You know, whatever. Mainly in Louisiana, in the Haynesville Shale is a large natural gas play for us. So when natural gas prices are going through the roof, that's where we're going to buy leases. We're going to buy leases in the Haynesville. The Permian Basin and the Stack and Scoop play is predominantly oil. So with $80 oil, we're staying in those locations.
Who has more questions for Jake? I think I've gotten through all the ones in the chat box. Anybody?
To hit on what you were asking about, you know, income, about, you know, how much money we can make and whatnot. What we try to do is we try to look at what the other wells have generated in income and how much they've produced, because if we're going to drill right next to them, there's probably a realistic expectation that we're going to hit something similar.
Mm-hmm.
I've never seen a well come on and do 1,000 barrels a day and then a well right next to it do 50 barrels a day. So most of the time, they're all different, but most of the time, if you got a whole group of wells doing 1,000 barrels a day and you drill right next to them, it's pretty safe to say that they'll probably do something similar. So that's what we do. We try to look and see, you know, what kind of reasonable expectation can we get based off of wells that are already there, that are already producing. And that's kind of how we vet our projects. We look and see, you know, what are the risks, you know, how much are they producing? And does it make sense? Do the numbers make sense where we can make money? If it's yes, we buy it. And if it's no, we pass. We pass on so many oil and gas leases. I couldn't tell you. I mean, we pass on a lot before we ever say yes. We'll probably pass on 30 different leases that we could turn into projects before we say yes to one. So for us, it's all about making sure we're in a good area that's going to generate income, that's going to make my investors really happy so they want to continue to invest.
Jake, what would you say, back to what we were saying earlier about risk, would be the best way, or the way that you guys head up risk? For example, sometimes there's, you know, key man policies, if you're the only operator of that well. Sometimes there's insurance for the actual physical asset itself, but since we're not involved in that, like what is the how do we reduce risk, or how are y'all reducing risk on these investments?
I feel like we're doing it by where we're participating and who we're participating with. Because if EOG or Devon or any of these big guys, they're going to spend $10 million per well. And if they're going to drill 4 or 5 wells all on one pad, all on one location inside one drilling unit, that's 40 or $50 million they could spend elsewhere. And when you're a $74 billion company, you have thousands of acres that you can go and drill anywhere. That's what makes us feel confident that, you know, if they're going to put 40 or $50 million into something, we're going to put $1 million, you know, $1 million raise into something. They must feel pretty confident that it's going to work out for them.
Yeah, I think that's right. Well, I'm gonna be quiet and let anyone else who has any questions turn on their microphone and ask them, or put them in the chat box, or whatever you want to do the next couple minutes.
I have another question.
Go for it.
Sure.
So you're mentioning how you're partnering up with these larger corporations, these larger
Yes.
oil companies. What's the incentive of them working with you and your investors? I mean, if it's a $74 billion company, why would they bother even?
Great question. They don't. The answer is they don't need us. They don't want us. They don't want our money, but they have to let us participate because United Exploration has a 40-acre lease that's inside of a 640-acre drilling unit. So to answer your question, they don't want us. They don't need us. They don't want us. They have plenty of their own money, but because of state laws, which are forced pooling laws, if you guys want to Google that, forced pooling laws, that's what allows us to do this. Is because if we have a lease in the state of Oklahoma and it's inside of a 640-acre drilling unit, the law says the operator has to let us participate for our proportional share. So I'm only buying leases in states that have forced pooling laws. And so that's a great question.
And the companies can go and buy these leases themselves.
They normally lease up about 80 to 85% of the drilling unit, and that's what allows them to start drilling. But what United does is we have state-of-the-art oil and gas mapping software. So we are able to see, I don't care who it is, where they're at, we're able to see everything. So what we'll do, if we see that Conoco or Exxon or whoever it is fixing to go drill some wells in section 3, lot 45, we can find that with our mapping, and then we can acquire oil and gas leases in the path of development. So when they move over to that next drilling unit and get ready to start drilling in the next 3 months, we've already acquired a 40-acre lease inside that drilling unit. And then that's what allows us to participate for our proportional share. So the whole name of the game for us is buying oil and gas leases that are in really good areas that big companies are drilling. That's how we're able to do it.
So just so that I understand, I'm sorry, I'm asking a
No,
lot of questions.
No, it's fine.
But if they're already going to be drilling in that particular location or doing the exploratory work, why wouldn't they lock in the lease in advance? Why are they giving you the time to go in there and lock in the lease before them?
There's always going to be bits and pieces, because it's what it is a bunch of parcels of land all pulled together. And so there's always going to be, as long as I've done it, I mean, since 2010, there's always going to be bits and pieces of leases that are inside those drilling units that that you can acquire. When we first started doing this, we literally got on the phone and would call people that were inside of those drilling units to get them to sell their leases to us. That's how we started. But there's actually companies, believe it or not, out there that own drilling rights. They own leases, they own minerals. And through those companies, you can acquire these leases. I will tell you, if you don't know what you're doing, be careful, because you can spend a whole lot of money on leases that don't amount to nothing if they're in some, you know, out in the boonies, or nobody's going to drill it. But you have to be really careful when you're dealing with companies. You gotta know who you're dealing with, where the locations are at, if it's even worth buying. And that's where our mapping and all of our research that we can do to see where it's at, how many wells are there, how many wells have been producing. We can look all of that up to see if the juice is worth the squeeze. So we already know all about the area and all of that before we ever acquire anything.
All right, Harita, I will turn it over to you.
Yeah, if we don't have any other questions, I think we can move on to the next section. Our next section is question and answer. Kaylee will give an update about multifamily. Kaylee, you want to go ahead and give a multifamily update? We can't hear you, Kaylee.
Sure thing. Okay, so for everyone who has questions, feel free to stick them in the chat. I am going to make this really simple. So really, I'm going to share my screen in a second once I get permission to do so. Continue. How do I do this? Over here. Okay, and I'll show you a picture, and the picture will be part of it, really, but not the whole thing. So this is a picture I took from the other evening. We went to Old Capitol Multifamily, and this is a lender in Dallas, Fort Worth here. They're actually national, but they're just located here. So this is just touching base on the fact that Dallas, Fort Worth is going to continue to be a really, really great place to invest in multifamily. This is something that you can see that the percent change, basically net Fort Worth and Dallas have been a leader in employment in 2022. And almost the highest in the country except for Austin. However, as we all know, a lot of tech jobs are changing right now, layoffs are happening, and so they're going to become equal or somewhere around the same. I believe that there may be some movement after this presentation to cores of cities, so that urban core, and so those deals that were in suburbia areas in, say, Dallas-Fort Worth or Austin specifically, because Austin has its own. I didn't take a picture of all the graphs and charts during the presentation to make it, a new one for you again. If you'd like to have access to the actual presentation, feel free to message me and I can get you with Old Capitol and get it to you. But really what we're seeing is a ton of overbuilding. And by I mean a ton, there's almost like a million new units on market countrywide, and the absorption is no way going to be equivalent to that in the next year. That's just not happening. So I just took some notes, realizing some of the trends of the hottest cities when things currently as of today are performing. So for example, that would be like Miami and some other cities in Florida are the leaders right now when it comes to net migration, people still moving there. It's still happening that way. However, there is a book I read recently kind of looking at what happened prior to 2007, 8, 9, and really 2007 is when we had a lot of issues, and some of these things are related. So overbuilding was one of the issues that was happening. There were a bunch of really exotic mortgages happening. So we are kind of seeing that with bridge debt coming due. However, I think that what I'm seeing personally is that lenders are willing to be flexible and extend the loan, change the loan, et cetera, because they don't want the asset back. But I'm not saying that that's the case for all lenders. So there will be some opportunity there. Back before 2000, before the last crash, there were a lot of overbuilding of condos in these vacation areas. So a lot of these areas that you're seeing, like for example, Phoenix, Tampa, I wouldn't count Atlanta, anything in Florida, pretty much. A lot of these vacation areas, they were overbuilding condos there. So now it's different. Now it's multifamily housing, trailing markets that had been doing well, like for example, Atlanta, Dallas, Fort Worth, Houston. And so that's just something to look out for, but that had happened back then where basically there was overbuilding happening and then people were not able to, it wasn't all absorbed, right? So then when you have all this vacancy, then the prices have to adjust and then there's no rental growth. So I see opportunities from this presentation, specifically in overbuilt opportunities for discounts in suburban areas that are A-class properties that are new. And then also there's a chart that we looked at 5 different ways that Phoenix is just way shot up. And I was just there. So if you're looking for major opportunities for several reasons, right now, Phoenix, I just was there, right? So they were getting 15 to 30 offers on 100 to 500 unit deals ish, 15 to 30 offers. And now they're getting one at a time because people, even the residents that live there, they know everything is overpriced and the rent is going to go backwards there. And so then you're going to be able to get a discount. There's a handful of properties that I went and looked at where the mortgages were originated in 2020, 21, 22. And those sellers are all willing to have the conversation right now about selling, and they're willing to take it at a discount. I don't know if it's steep enough of a discount, because what I'm seeing is that some owners, like they bought in 2009 or so, 2014, early on, for like 17 to 35, 38K a door. And now the same types of properties are selling close to like 400,000 a door. What? Yeah, so way overblown for old product. So they're going to have to take a major adjustment there. And because variable rates have been pretty scary, and these people are likely in some kind of a floater or bridge debt, they're willing to sell. So if you're looking for opportunities, I would definitely say suburbs of Phoenix and Phoenix. I think the knife's going to fall there pretty quick here first. I think that Dallas-Fort Worth is less of an opportunity than the suburbs of Austin. Like I mentioned, A-class properties that have been built. When I say properties, I mean multifamily around the city. So a person I follow, I spoke with the other evening, they're purchasing something in Buda right now, and then Hutto, and some other properties that they're going kind of back in time and purchasing 1970s, 80s builds where they were just focused on A-class only for a while because of replacement costs. You know, it made sense for what you were paying for it. And now they purchased their first old deal in a while, just because it's in a suburb around Austin, and they're seeing people leaving. And then also some other factors that overprice basically residential there. I think I've seen that it's overpriced 30 to 50%. Not saying that all of the multifamily is the same, but it definitely follows the same trend. We have a property management company that's based out of there, and I'm always poking them every week to see, you know, what's happening, what's changing with prices. So really just, for example, if you're looking to see what's going to happen with the Fed, if you're not already following Jay Powell, that's somebody who, if you've watched every single thing that he has said, that has been displayed in reality. So just keep watching what he is saying. And essentially what that is that in April and I think May, there may be another rate hike. And then I think we're going to pause for a minute and kind of see how that affects inflation. Because if it can reduce or slow down, reduce really inflation, then the goal has been met, and then we can kind of change bond buying patterns, therefore interest rate patterns, to take those mortgage interest rates down more. That's just the pattern that happens. So yeah, follow Jay Powell is what I kept hearing. Also, the economist we spoke to, if you want more information from him, his name is Greg Willett, GWILLET at IPAUSA.com. He's the chief economist for IPA. So that's the Institutional Property Advisor team for Marcus and Millichap. And he seems pretty passionate about his job. And so I'm sure he would exchange conversations with you if you needed any advice. Another thing to be looking for, not just those suburban opportunities, I would think, because I don't believe that these are necessarily vacation markets, but if you're looking in Tennessee outside of Nashville, so close to Nashville, Charlotte and those areas, sort of in the Research Triangle area of the Carolinas, and then Houston, these are areas that I also see as just being very stable when it comes to having job availability, not necessarily being a vacation market where, you know, you have these crazy influx and outgo of people, you know, minus Nashville. I think Nashville is going to become a really good opportunity because it's a tourist town. So if that ever changes, anyway, net, just those surrounding areas to Tennessee, Charlotte, Houston. And if you want, like I said, the supporting information from the slides from Old Capital, feel free to email me, Jane at apartmentqueeninvestments.com. And I'm happy to get that to you from Old Capital. That is all of this stuff, this data behind what I just said. I just tried to summarize it and make it pretty easy because they reshared the same information, 100 different charts, you know, different ways. And then also something, if you didn't already know this, last year, essentially, we were seeing like 0% rent growth. Not literally zero, but we were not seeing any rent growth last year. It really slowed down in 2022. And then for this year, we think that that's going to be remedied a little bit more. It's going to increase. But for cruddy secondary scary markets, for example, they're looking at 1.5% rent growth, maybe to 2 max. And then these larger markets like DFW that have done well, 5 to maybe 6.5% rent growth. But we typically assume 2% or so, even for good markets, just to try to keep up with normal inflation. But we're hoping that that will get adjusted. And then right now, this is an interesting thing to learn that currently unemployment nationally is 3.4%. And that is the lowest our country has seen in 50 years. And so we are trying to listen to like, what is the underlying reason for this? And it's really interesting because basically you have baby boomers that are retiring, so they're no longer in that job pool anymore. So what's interesting is when normally people would be aging and they'd be getting a job as they're born, and we would have more jobs. So it's just interesting that the baby boomers that are retiring, that is affecting this unemployment number, because they're not employed, but they're not considered unemployed because they're retired. So even though that's a large population, that's not being counted. Do you see what I'm kind of saying? And then also the job pool is smaller. So it's really competitive right now. And it's hard to find, it's hard to find good people. It's just a smaller job pool to pick from. So it's very competitive. And like I mentioned, a lot of people have retired. So it's interesting that we're seeing low unemployment, and then to basically ride the tail of that, as I showed this right here, this is what we've seen in change from job creation for Dallas-Fort Worth. It's been the leader for all of the, like you can see the amount of jobs that was created here since pre-pandemic. It's a crazy amount of jobs. I didn't give you the second slide after this, but it adjusts supposedly to about 28,000 jobs coming out of Dallas-Fort Worth, yet still being that same 8 to 9% leader in change. So it's still going to be increasing, and it's still going to be increasing the same amount. But then when you look at their predictions, or this guy's predictions, the Economist, for the next couple of years, all the other job markets are going to be even lower when it comes to being able to offer jobs. The only spike I saw was New York City, that it looks like they're trying to really ramp up their hiring in New York City, but it's not necessarily tax friendly there. It's not necessarily super landlord friendly there. So that's not something we'll look at for for apartments. So that's really what we garnered the other night. That of course we know absorption, like I just mentioned, can't keep up with completions and with the units that are coming online. It's almost like 1 million units. It's like 997 units or something crazy. And there just isn't a need for that. So here's the funny part is you might be saying, well, hold on, there's the housing crisis, that's affordable housing crisis. So what people went out and did is they built these A-class properties that are really expensive to move into with the nicest amenities possible and the highest rent they could possibly get, versus making something that was for maybe like LIHTC, or something that was more of a sustainable, smaller unit. For example, something like you guys have seen Boxable out there, their methods of building materials and the size of those units are very small. That is something that would translate to affordable housing that could be turned into, say, a complex, or someone could come up with creative ways to use non-traditional building supplies, et cetera, and just no one's doing that. No one did that the last couple of years. And so now we have all this product that's all like super nice and brand new, but people aren't going to be able to continue to afford that. And typically what we also saw, I don't have the chart for you, which is good news if you ask me, is now we're going to see the flip in the chart, where we had all these units that were needed in the last couple of years, and people were able to afford it for a variety of reasons. Salaries went up. That actually has to go down. That's another reason the Fed is adjusting all of these things. So people were able to afford nicer rents. So now, normally when things get constricted, jobs get lost, salaries are moving down, the labor pool is widening because there's less demand for their work, et cetera. The people will leave those nicer units. And so what ends up happening is it's not a huge spread, but I think it was like 6% or so vacancy in these A-class properties. And you're seeing like a 4.5% vacancy. I'm probably off by a little bit, but that's about the spread I remember. Where in C-class properties, what's happening is way less people are leaving because they want to stay in there. They've qualified for their unit. They want to keep being able to afford what they have. Whereas these nicer properties, people will leave, and they will usually come to lower class properties if they're not moving in with their family or moving in with a friend. And as we also know, because of mortgage changes that have happened, I've got friends all over the planet, that are in real estate in different states, and all of them are just like clawing at business, wanting to do any kind of deal because people cannot get qualified for mortgages, especially those, working class type people. So we're in the phase of the world right now, or the phase of the market where a C-class property would be really attractive to have or to go after. So that's really an update on, what I see as far as opportunities, what's out there, absorption rate. And then what I would say, if we were going to make some more assumptions for underwriting moving forward, I would say to be conservative, we need to have our vacancy at least at 7%, because that's also going to change as well. And then I would really be super conservative when it comes to rent growth. I wouldn't necessarily say 0, but I mean, I would try to reason with whatever broker we're buying from or whatever owner we're buying from that, like, look, like, there's no guarantee. We've had this incredible amount of growth the last 2 years, in rent, not last year, but last couple of years before that. And there's no way to sustain that. And so if we're going to go in, here's our pro forma, like it's going to be at like 2% or less, rent growth, just so you can make sure that you can capture that. So hopefully some of that was helpful. Really, like I said, I'm seeing that jobs are leaving. I think that there's false growth of people moving to Miami and to Florida. I think that will, there's a lot of vacation or luxury Airbnb type properties that are there. I think that people are going to kind of distribute a little bit more to normal areas like Texas, Tennessee, Charlotte, Houston. Well, it's Texas, but non-vacation markets, because those typically tend to be expensive. And I think they're overbuilt. Specifically, we have these short-term balloon mortgages that are coming due. People that have all these different form. We used to have all these overbuilt condos, right, for vacation homes. Now we have all these crazy amounts of Airbnbs that are out there that are luxury versions of so the loans that are on these property, people are typically taking like a hard money loan on an Airbnb, and they're trying to do some sort of cash out, but with everything getting tighter, I don't know how that's working. And so I could see someone that's holding a whole bunch of vacation homes, basically needing to offload those because they can't afford the mortgage anymore. People aren't renting, or they can't refi and actually execute out that business plan to get out of that hard money loan. So it's just a lot of similarities that I'm seeing to 2007, not nearly as extreme, but just very similar. And that period, mind you, was 2007 to 2009. It got rough. And then after that period, things started to tick upwards. And so I'm hopeful that, I don't know about y'all, but I've kind of been sitting on my thumb for 14 months at this point. COVID was the lockdown. It's been 3 years, already passed by very quickly. So my hope is that by 2024, our 2-year window of tough stuff will have passed. And then essentially, if you're making it to 2025, hanging on to your property. So at this point, if they're stabilized, you've refinanced into some kind of a non-floating rate debt structure, and you can just hang on, I think we'll be okay. So that's just what I heard and what I could reinforce with in reality operating as well. Okay.
Thank you for the update, Kaylee. It was a lot of information. I got a lot of information. Thank you so much.
Someone said, I haven't looked at the general multifamily market in Phoenix, but have been reading that short-term rental markets in Phoenix is extremely oversaturated right now. Yeah, I would say that. I can even tell you I was there for Super Bowl weekend this last weekend, and I have friends that own businesses there that's all they do is luxury Airbnbs, and only the most $15,000 a day, ridiculous type pads. Those are the ones that got rented during last week, but she did not see a whole lot of renting activity, which is bizarre for literally the Super Bowl. Everybody goes there. So that, I think that's right. 100%. I think that may be an opportunity if you're looking, whether it's multifamily or grab a gaggle of someone's portfolio that they have a bunch of houses that were Airbnb. Yeah, I think that's right.
Yeah, I read the percentage of increase in Airbnbs and short-term rentals between 2017 and now increased by 52% in that region. So it's just way too much supply.
Yeah, that sounds right. So for us, one thing I've gotten a lecture 4 or 5 times. So for us, not that you asked, but we are going to be focusing specifically on Dallas Fort Worth, and that is it. I'm not even going to be looking at Houston anymore. I'm not even going to be we got to be super, 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 super strict. So just putting that out there into the universe. If you're involved in Dallas Fort Worth, love to network with you. But I just wanted to pop in the information about Phoenix because I did, go out there to see a friend. And then of course, when I go anywhere, I always go scalp for deals. And so there are some, there's a good like 15 that are B class out there that I think, because we actually sold a deal out there last year at a 3.67x. So we got out right in time, but I was looking at that same area that deal was to see, who has a mortgage that they originated in 2022 or 21, and to see who'd be open for discussion. So I'm happy to pass those along if you're interested in going to execute them, because I did all the work already. So there's that. Anybody else have any multifamily questions or just like random questions, like problems we've run into, things with the operation, how we do things, goals? What do you got? Like, this is the time. What we wanted to do is open a forum for everyone that attends to be able to literally just get to know us and ask whatever they want.
When you're selecting a property, how do you vet it? How do you vet the property before you buy it?
Yeah, so some of the parts of it that I really have liked a lot is if you're buying from an operator that you've already bought from before. And so you're not really having to be as stringent with looking at everything. You still have to do your rent audits, not rent audits. You have to do your lease audits. You have to still look at, all of the financials yourself. You have to look at the mechanical, electrical, plumbing. You have to bring in your whole DD team. You have to look at all the units. I mean, do all the normal stuff. But I find that if we're buying from a group of people that we have before, and then there's actually a couple of groups in Houston that I was talking to, they have some in Dallas too, thank goodness. But just the way that she runs her business is just like so by the book. Like, we still check, but I know that she's ex-military and makes it her goal to make sure that everything is like perfect. So she'll hand you this Dropbox account with like subfolder on subfolder on subfolder of everything you could ever think of, beyond even like the paid invoices, like pictures associated with each thing that was done. And it's just like so in depth. So I really enjoy buying from those that I've had experience with before.
Sure.
There's a couple, depending on the size of the deal, there's a couple property management companies out there that have a due diligence arm to them. A family office friend of mine in Florida recommended them to me. I think Cortland's the big one, and I forgot who the small one is. I have it written down, but they will basically do that for you. And it's got to be a big deal for this to make sense because it's expensive, but then they actually have like insurance for their lease audits. They have insurance because you're wanting to make sure you don't have any false leases. You don't have this vacancy loss the moment you close, because that's happened several times to us.
Sure.
And then also like, you've got several leases that are from the same family name or executed like the same day, or like, you know what I mean? Things that will turn into a problem. So it's really just following our process and then working with those that do a good job.
Sure. I think I don't want to speak for everybody, but I think has been a problem with oil and gas. When you're looking at a multifamily unit, you can pretty much calculate, okay, this is what it's going to cost. This is how many units I have. This is how much money I can make for the most part, right?
Mhm.
And that's the complete opposite with oil and gas. You don't know how much you're going to make, how long the world's going to last and whatnot. So I think that's kind of what, and it's not all real estate investors, but I think a lot of real estate investors, because I talk to a lot of people on a daily basis, it's the mystery of the unknown, the fear of the unknown. It's like, it's too much for me. So that's why I asked, because I know that usually you guys have a blueprint of, how it's going to go before you even get into it.
Yeah, usually, but there's still things that happen. And I just
Sure.
find that if there's some kind of way to get some kind of insurance for everybody that's involved in like the decisions that carry some kind of liability, that's really like the thing I care about, because I've done so many
Sure.
different DD processes or whatever, and like they don't take any liability for all the stuff that they end up finding or they end up not disclosing. And so anyway, I'm just tired of paying
Yeah.
someone to like not tell me the full truth and then having to hold the bag for it anyway.
Sure.
Yeah. And then another thing we're working on as we grow is, like I mentioned earlier, like key man insurance. You know what I mean? Like I've got a fund right now where I'm like the sole person in it. And
Mhm.
so if I go away, like what happens? There's got to be some kind of backup there. And now I am taking on 2 partners so that that problem goes away. But you know what I mean? Like just risks. There's so many of them.
I see that.
So many of them. All right, everybody, I'm going to give you a link. If you are interested in getting qualified for multifamily investing, I'll put my link there. Jake, do you have something?
I have I have a website and an email address if anybody wants, wants to see an actual partnership offering documents and whatnot.
Yeah,
It's let me just tell you what it is.
that or type it in, whatever you like.
Okay, it's unitedexploration.com. That's the website. And then my email is jake@unitedexploration.com. Pretty straightforward.
Yes. Perfectly straightforward.
And as long as you're an accredited, investor, I can definitely send you the information. For us, like it's like $1 million net worth, 200,000 to 300,000 combined with the spouse, yearly income. I'm sure it's pretty much the same across the board. I would imagine. Accredited status.
For our, yeah, it is.
Yeah. Okay. Yep. Same thing for us. So I just got to make sure that I'm talking with people like that.
Yeah.
Just FYI.
If you're interested and you're accredited, give Jake a buzz.
There you go.
I stuck in our link because we have the ability to take those who are not accredited also. So
Oh, okay.
we're not kicking anyone to the curb. We have an accredited option and a non-accredited option. So
Gotcha.
first the investor has to get qualified. That's why I dumped the link, and then I'll
Right.
know which way to go.
Makes sense.
One hundo. Well, everybody, happy hump day. Harita, I'll turn it back over to you.
Yeah, I think thank you so much, Jake, for coming and educating us on oil and gas.
No problem.
And yeah, I learned a lot of stuff. And I really enjoyed the session. And Kaylee, thanks for educating us on multifamily as well. It
Cool.
was a lot of information.
And there's more stuff that'll come, like literally, if you guys want to get on here and ask us stuff about our portfolio, like we're in the middle of a refinance on one deal right now. I don't know if I mentioned this earlier, but I'm going to move into a property right now. We have another one that is refinancing, another one that is just refinanced. Like, and through each of these deals, they all have had their own different challenges. And so we're working to add those to a standard process so that it's like, oh, we'll hand a set of documents to the lender and be like, okay, here, go refinance, you know what I mean? Versus having it take forever and being all over the place. So anything like that you want an update on? I mean, I'm super in the weeds, so I'm happy to answer any questions.
Do I need to put in Jake's information in the chat?
If you got it
For
from
people to
sure.
Sure. That would be great.
Thank
you.
That is the company, and I need to find your.
And then my email address is jake@United Exploration. If anybody wants to email me personally, feel free. Email away.
Now I'm gonna bother you all the time.
That's okay.
Okay.
It's hard to
Okay,
bother
I
me.
put-
I'll be
I-
like, hey, what color are your socks? Hey, what are we doing today?
I'll respond.
Awesome.
Yeah, we'll have our next meeting on March 15th again, and I will try to find a good topic for us, and find a good speaker to educate us.
If anyone
Thank you
has
so
any
much
topics
for
that they want to learn about specifically that have to do with creating passive income or maybe like a super niche part of multifamily, feel free to email Jane, Jane at apartmentqueeninvestments.com. Any topic ideas, and then that way we can actually give you something that's valuable. We'd love to do that too.
Thank you.
Oh, you betcha. Thank y'all for coming.
Yes, thank you for having me. I do appreciate it.
Jake and
you.
Kaylee, before you guys sign off here, I just wanted to do a make sure you saw my message. I messaged you both about if you would be interested in doing an interview on a podcast, business podcast that my business partner and I do. It's called Screw the Stock Market. It's all about alternative investments.
Okay.
So you guys would be perfect for the show. We would love to have you guys. Jake, I think your topic is very interesting. We would love to expose our investor community to you on the show. And Kaylee, we do multifamily as well, so I think you would fit in great also. So
Yeah.
please feel free. There's the email in the chat. It's called info@screwthestockmarket.com. If you're
Okay.
interested, hit us up. We would love to have you.
Okay. Thank
Yeah.
you.
Right now.
No problem.
All right, Aziz, that's great. Yeah, screw the stock market.
Yeah,
All right,
we're
y'all
having
have
a
a
little bit of
great
fun with the
Wednesday
name.
Okay, you guys too. Thank you so much again. Y'all have a good one.
You too.
Take care.
Bye.
Bye.